Hi everyone, good morning. Welcome back to the channel. So today's lecture is about how decisions are actually made in the real world by companies, by government, and by individuals. We will talk about how companies decide whether to invest or not, why many bad projects still get approved, why and how government value the future, why consumers overspend and undersave, and also how all of this showed up in real markets over the last 3 years. Before we start, just ask yourself, uh, have you ever continued something even after knowing it was a bad idea? And I think this is the one question that connects everything that we are going to discuss today. So just think about it. Have you ever continued something even after knowing that it was a bad idea? So, what is actually capital budgeting? So, capital budgeting is simply it's simply how businesses decide whether to invest in long-term projects or not. It's like basically yes, simply how businesses decide whether to invest in long-term projects or not. So examples are opening a new factory, launching a new product, investing in technology, entering into a new markets. And so all of these actual decisions actually involve spending more money today and expecting benefits in the future. And this is where discounting becomes essential, which we have discussed in the previous lecture. With capital building, this is what we are actually discussing about. So, so this is where actually discounting becomes essential and net present value. Since if we talk about net present value, let's make it very simple. So uh, net present value, and after adjusting future cash flows for time and risk, does this project creates value today? So that's basically net present value. And if the net present value of a project NPV of a project is greater than zero, so this means that the project is actually adding value. And if the net present value of a project is less than zero, so this means that the project is actually not adding any value or destroying value. This is destroying value. Uh, real life, if I were to give you a real life analogy of net present value, so think about it that you have invested 1 lakh rupees today or 1 million rupees today, and you have gotten, let's assume that you have invested $1 million today, and you have received $1.2 million, or you will be getting $1.2 million. So is it worth it? And you actually have to be honest about it. So if you invest $1 million and get back $1.2 million in risky future payments, is it even worth it? Risky future payments in the sense means you have invested today, this much you will get, but the risk of getting this is way too much. So there is risk involved and there is high risk involved. So you actually need to understand. So since we are talking about behavioral biases, we will be discussing about behavioral biases. So I have structured the content in such a way that you get a taste of a little bit of behavioral biases, and that's why the question is structured in such a way. So if $1 million you have invested in the future payments to, you are going to receive the future payments of $1.2 million, and the risk is very high even though your net present value is actually more than zero. Is it adding any value to you? Is it worth it? And the net present value should tell you the honest answer. To understand the net present value, you will factor in the risk factor into the net present value, and the risk factor will be the deciding element of the discount rate. The This will be the deciding factor of the discount rate, the risk, the because of high risk. So this was just an example. I hope you have understood what I'm trying to convey here. So let's talk about the next point, which is the internal rate of return. So what does internal rate of return means? So this is actually what percentage return does this project appears to generate? And it sounds simple, right? But here's the problem. IRR can be misleading. Internal rate of returns can be misleading because projects differ uh, because of the size of the project, because the projects have a different size. Cash flows comes at different times. So this actually internal rate of return is might be misleading because of the size and the timing of the projects. The timing is related to the cash flows, and the size is related to uh, the capital involved, the capital involved in the project. So let's assume that there are two projects, project A and project B. So project A is going to earn you 30% on your 1 million dollars, and project B is going to earn you a 15% return on your uh, 15% return on your, let's say, $10 million. Since we are talking about the sizing and the time, now understand this thing. Uh, if we look at the internal rate of return, so IRR will be favored by this project A, but NPV will favor this project. So this is why if this project is favored by internal rate of return, and this project is favored by net present value, and net present value, it would be net present value will be looking at the cash inflows and the cash outflows. So if NPV favors this project B, and the uh, internal rate of project internal rate of return favors project A, as a financial professional, you should be able to decide which project, and the logical reasoning behind this, which project should be beneficial for the firm, for the organization. And since simple words, since we are not going into detailed discussion about IRR and NPV, so you need to understand, we always favor the net present value, because here the cash inflow and the outflow is involved, and the analysis is done on the basis of the real flow of money. And in valuations, this is preferred more. Okay, I hope this is clear. I uh, Then the difference between net present value and the internal rate of return. So internal rate of return is basically what percentage return does this project appear to generate. And internal rate of return is basically the rate of return at which the present value, the cash in outflow, is equal to cash inflow. And if a project is generating if a project is generating more, okay, so there are two projects, project A and project B. and project A has more IRR. This is favorable, IRR favorable. This is not favorable to the IRR. And if we say about talk about NPV, and this is not favoring the NPV, but the project, the NPV is favoring project B, always go for those projects which are favored by NPV. Okay, this is what I actually wanted to tell you, and I let's move to the next question, next topic. So let's talk about behavioral biases in the capital budgeting. What does behavioral biases mean? And in theory, companies should always choose. Before that, let's uh, projects with the behavioral. Okay, so companies should always choose positive NPV projects in reality, but they do not actually. And why is that? That's when the behavioral biases comes into play. So behavioral biases like overconfidence in forecasts. So managers believe that forecasts are better than reality. There is optimism bias in cost and time estimates. So this means that costs are underestimated, timeliness looks unrealistic and short. There is a biasness of loss aversion. So this means that managers refuse to shut down the failing projects because we have already invested so much. And sunk cost thinking. Past spending influences future decisions. So even when it should not be doing this. So sunk cost fallacy, that's what is called sunk cost thinking. They have invested way too much into the project that now they do not want to exit, and they believe that the project is going to get better. And herd behavior, this is important. Herding means that if your competitors are investing in these kind of projects, you should also invest in these kind of projects. So that's herding behavior. If others are doing this, we should also do this. Don't do this unless until you have the expertise. In these biases can lead to acceptance of negative values projects and inefficient allocation of capital. So the key message here is that many bad investments survive not because they are profitable, but because humans hate admitting that the investment is bad, and it takes a lot of courage to to admit uh, whether the investment. So whether you actually made a incorrect decision, and now you are willing to improve, make it changes to your decisions, to uh, accept failure and to learn from it. So this is where biases comes into play, and humans are biased, and that's why behavioral finance comes into play, and you need to learn study about behavioral finance. If you think from a finance perspective, uh, getting a home, getting a house will not be beneficial. Getting a house will not be seem uh, profitable, but people end up buying a house. They will teach that buying a house is not profitable, but they will end up buying home. They will say that doing lavish marriages is not it's useless, or it's not sensible as per finance, but they end up doing lavish marriages. They will say that getting a car, buying a car is not sensible as per finance, but they will end up buying a car. They will say that foreign trips are not sensible, but they actually end up doing those things which they do not believe in. So this is where biases comes into play, the behavioral biases, and specifically biases from the perspective of finance. So I'm specifically talking about biases or behavioral, uh, financial behavior, biases or behavioral finance. So you need to read, educate yourself about finance, behavioral finance. Uh, People invest in those securities which they think the are not profitable, but they still do invest in those securities. So to end up, so and they end up investing in those securities which they do not believe are profitable, but they still end up doing it because mm, subconsciously they are biased, and it's totally normal. Uh, but as a financial professional, you should know. Okay, so let's talk about what is social discounting and public policy. And I'm trying. This is the last topic for this video, and I have tried to keep it small. Uh, so, since we are talking about biases and rates, this should also be covered in the same topic. So, social discounting. When you talk about social discounting, so government actually invest in roads, education, healthcare, and climate policies, and these kind of projects. And these projects actually benefit people uh, which are decades into future. So they are not born yet. So government, the cleaning of the rivers, good maintaining roads, education policies, healthcare policies, the climate policies, reduction of pollution, and these projects, government. Uh, since government is actually so these projects are actually known as social discounting projects. These projects benefit people which are not born yet. So the government asks how much should we value the future generations, and the social discounting rate formula is here. So it's the rate formula is rho, which is a Greek letter, and eta, which is again a Greek letter, and this is the growth, expected economic growth. So, so society's patience is how much we prefer today over tomorrow. So this is society's patience. Concern for inequality is defined by rho, and G is the expected economic growth. Even though it's not of any use to us as of now, but uh, since we are discussing about social discounting and we have previously talked about rates, this social discounting we should know. And the key idea here is that lower social discounting rates means that more importance is given to the future benefits. That's why climate policy debates are really discount rate debates. And since we are talking about it, okay, why we are talking about it? So since climate, just one example which I wanted to discuss about. Since we talked about climate, so there is going to be carbon credit. So if companies are actually into manufacturing or other domains where there is a lot of pollution involved, so in future this is going to be a new business model, or it's already in play. So companies actually are selling carbon credit. So what they are doing is they are actually those kind of companies which are actually into manufacturing or where there is a lot of pollution. So what they actually have to do is they actually need to have a budget for carbon credit. If they are, this means that if they are polluting, so they actually have to do something for the environment also. So this actually is a good initiative, and uh, now if those companies are going to do somewhat something toward the society. So this is actually a part of social discounting and public policy. Carbon credit. Okay, so let's move to uh, behavioral finance and consumers. So since we have talked about almost everything, this behavioral finance and consumers. So I would like to ask you one question, that why do people overspend at times? And behavioral finance actually explains why individuals prefer immediate reward uh, rather than delayed gratification, use too much credit rather than using their own savings, and undersave for retirement. And this actually, all this happens because people apply very high personal discount rates. For example, let's assume let's take an example. $1,000, 1,000 rupees today feels like more valuable than 2,000 rupees in 2 years. And this thing, marketers, those who are actually into marketing, they actually understand this thing perfectly. So buy now, pay later. If you see impulse buying or heavily reliance on credit cards, under saving for retirements, vulnerability to marketing and framing efforts. So if you see, there are new structures of marketing where there is buy now, pay later is being introduced. Limited time offers. When they say limited time offers, they actually want you to instant cash back. When you hear these kind of things, these are all marketing gimmicks, and this doesn't mean anything. They just want you to spend more. So they just want you to spend whatsoever you want to save. They want you to. Uh, they just want this. So okay, this is actually this behavioral finance is actually understood perfectly by those who are actually into marketing. And have you ever bought something just because it was on sale? And if you have, this is actually behavioral discounting in action. So this is why actually I wanted to talk about behavioral finance in this video only. I hope this is clear. And let's talk about some real world illustrations where there was quantitative easing and tightening was done. So the recent world examples where quantitative easing and quantitative tightening was done in the market. Just give me a moment. So post-pandemic rate hikes. So recent economic events in 2002, 22, and 24, there was a market correction. So interest rates rise and discount rates were increased. Stocks and bond markets were corrected. Tech stocks fell down the most. And why tech stocks were fall down the most? Because their profits lie far in the future. So if you look at a tech company, so their profits lie far in the future. That's why when we talk about AI and technology rallies, uh, AI stocks rose sharply because investors expected future growth, and the discount rates were perceived to be falling. And optimization of FOMO, fear of missing out, actually dominated. And this is discounting plus behavior together. So this was actually created by uh, low discounting rates and strong optimism of the investors. And in the recent times, this has actually happened. Cryptocurrency boom and the burst in 2022 and 23. Uh, this actually has showed herd behavior, overconfidence, and extreme sensitivity to liquidity. When money tightening, when money tightened and policies collapsed, the prices collapsed. Rising mortgages in 2023 and 25. This is actually the real world illustration of reducing housing affordability and altering household consumption decisions. And here, higher rate led to higher EMIs, reduced housing affordability, uh, delayed consumption decisions, and this affected ordinary households, not just markets. Uh, and warning over asset overvaluation. So, uh, so, long periods of easy money has created inflated asset prices, reduced risk perception, encouraged speculation. And this is how actually the bubbles form in the market. Uh, uh, and if we talk about how individual choices shape the economy, uh, so to every decision to spend, to save, to invest, this actually adds up to the economy wide outcomes. So personal behavior leads to market outcomes, and market outcomes actually lead to public policy decisions. And so let's bring everything together. So, so this rates, if we talk about rates, discounting, behavioral finance, QE, and QT, these are not separate topics. So they actually form one system. Numbers actually influence the behavior, and behavior actually amplifies the cycle, and the policies reacts to the outcome. And the final message for you folks is to understand the economy. You must understand both mathematics and the human psychology, not just from the quantitative perspective. Uh, you need to think from a human psychology perspective also. In or and the rates, the rates is actually very important. The rates, understanding about the rates is very important because when you are value, okay, when you will read about valuation, you will be using assumptions, and assumptions will be the plugin on the basis of which your valuations will work around. So your valuations will be moving around, and if your assumptions are not practical, uh, you actually have to use real life your assumptions should reflect that those are achievable, or those are based on real life conditions or real market conditions. Because if your assumptions are incorrect, your whole valuations is incorrect, and you will only be able to get, or you will only be able to understand how to use assumptions, how much assumptions to be involved, or how much assumptions to be used if you have the knowledge. So your assumptions, the usage of assumptions will reflect how much knowledge about the subject you have. So that's why rates is very important. Discounting rate, monetary policy, behavioral finances, and all these things to understand the psychology of the market. It's important. I hope you have learned something of value today. All the very best, and I will see you in the next series. And sorry, the next topic of cash flows. We have completed the capital asset pricing model, where we have discussed about capital asset prices, weighted average cost of capital, leveraged beta, and discount rates. Now, the next we are going to start with cash flow concepts. All the very best, and keep learning. My name is Deepak Bisht. Thank you for attending the session.